Gold set a record above $5,500 an ounce in January. Today it's near $4,100. So the real question isn't whether you missed the run, it's what you'd be buying it for. By the end of this, you'll know the three questions to answer before you buy an ounce of gold and how the answer changes what you actually keep after taxes. Here's the direct answer. Whether now is a good time to buy gold depends far less on the price than on what job gold is supposed to do in your portfolio. Gold pays no interest and no dividend. It has no earnings. Its entire return is whatever the next buyer is willing to pay. So it can't become an income asset. It's either a hedge or a bet. Decide which one you're making before you look at another price chart. Start with the history, because it doesn't say what most people think it says. 2025 was gold's best year since 1979. Then in late January, gold pushed above $5,500 an ounce intraday. By late June, it briefly slipped under 4,000, and it's been sitting near 4,100 since. The World Gold Council looked at every time since 1971 that gold dropped more than 20% from a record high. There have been 8. The average decline was 36%. The median was 29%. Right now, we're about 25% below the January peak. That cuts both ways. It tells you a pullback this size is ordinary for gold. It also tells you that ordinary for gold is a drop that would wreck a withdrawal plan if you leaned on it. Gold's big drawdowns are normal. That's not reassuring. That's the whole point. Second question, if you buy gold, what are you selling to buy it? This is the step almost everyone skips. Say you've got $1 million portfolio and you want 10% in gold. Hypothetical numbers just for the math. That $100,000 has to come from somewhere. If it comes out of your bonds, you've swapped an asset that pays you interest and steadies the ride for one that pays nothing and swings even harder. That isn't adding a hedge, that's changing your risk. Gold is a fire extinguisher, not a furnace. It may well be worth owning. It's never going to heat the house. Gold doesn't get its own slot in your plan. It takes a slot away from something else. Third, and this is the one that catches people, where you hold gold changes what you keep. Physical gold and most exchange-traded funds backed by physical metal are taxed as collectibles rather than as ordinary investments. That means long-term gains can be taxed at rates up to 28% instead of the usual long-term capital gains rates. Same holding period, different tax bill. And a large realized gain doesn't stop at your tax return. It raises your income for the year, which can raise your Medicare Part B and Part D premiums 2 years later through IRMAA and can pull you into the net investment income tax. Your investment mix, your tax return, and your Medicare premiums are one decision. They just tend to get made in 3 different offices. The after-tax return on gold is not the return you saw in the headline. So is it too late? Wrong question. What's the job? That's the question. If gold is insurance against a bad decade, size it like insurance. Hold it in the account where the tax treatment hurts least. And stop checking the price on your phone. If it's a bet on where the price goes next, call it a bet and size it like one. If you're not sure which one you'd be making, that usually means the portfolio and the tax plan aren't talking to each other. That's the part we fix. At Madison Partners, the investments, the tax planning, and the Medicare math sit with one team so you can actually see where you stand instead of guessing. The link's below if you want to look at your plan.